Hey everyone. So today I'd like to talk to you about different ways that sometimes you can find value hidden in plain sight. And we'll go over a few examples, starting with Bausch. But just to be clear, this isn't investment advice. I want you to do your own research. I don't ever recommend you to buy something or sell something. I'm just going to give you some tools to help you do this if you wanted to pick individual stocks instead of just investing in the index. Investing in the index is quick and easy, and it's perfectly fine for most people. But if you want to dig deeper and do some work and read the SEC filings and listen to the conference calls and do the work required for individual stocks, hopefully here I can give you some tools that'll help you with that. So before we go further, like and subscribe to this. That way you'll get notified of further videos that I do when I release them. Let's start out with saying that a lot of times things are cheap for a reason, but a lot of times you can't identify the reason, and sometimes there's value to be had. So for instance, Bill Ackman, who's a legendary investor, he's a billionaire, runs a fund called Pershing Square. And again, this isn't a recommendation, but he runs a very concentrated portfolio, sometimes 6 stocks, and people eagerly await the quarterly filings when they see what he's bought or see what he sold so they can follow him into trades. But he runs a fund in the US, and that's the one people tend to look at to see what he's buying and selling. But he also runs a fund in the UK, and that fund has the same stocks that they do in the US fund, and it trades at a 20% discount to the NAV. So the NAV is the net asset value. So if you bought the US stock, which is a mutual fund, and you look at all the stocks in there and add them up, that's the NAV. And the fund in the UK trades at a 20% discount to that. So if you are one of the people who would be following his trades every 3 months, looking at what he bought and sold, you can buy the exact same things he bought when he bought them. You don't have to wait 3 months just by buying this fund, because everything that's in there is in the other fund in the UK at a 20% discount. So why does that discount exist? Well, basically, it's the difference between an open-end fund and a closed-end fund. So the fund in the US is what's called an open-end fund. And if you were to sell the shares of the fund would give you back exactly what the NAV is that day. And the reason for that is when you sell your shares, the company sells a certain amount of stock and then gives it back to you. And when you buy shares in the company, because it's a mutual fund, they buy more shares in the stock, and you're getting a percentage of the mutual fund. With a closed-end fund, they raise a bunch of money, and then that money trades on a ticker symbol on an exchange, and then you're buying and selling that ticker symbol. So when you buy or sell the ticker symbol, Pershing Square in the UK, you're selling that stock in Pershing Square. You're not getting redeemed from the company itself. So there's times when that can trade at a premium to what's in the basket, and there's times that it can trade at a lower discount to what's in the basket. And usually it's a little lower because there are fees involved, and things like that, a management fee from Ackman. So, but a 20% discount, that's pretty steep. So if you believe in him and you believe in the performance, instead of checking every 3 months what he's bought or sold, you can just buy this fund, and then you get the same stocks but 20% cheaper. There's other ways to find value in plain sight, and we'll talk about Bausch in a second, but sometimes you'll see a company owns a lot of shares in another company and it's undervalued for that reason. So for instance, Berkshire Hathaway owns about $100 billion worth of Apple stock. And there's other companies where you can find sometimes that the company actually trades for less than the stock that it holds. So the famous one a few years ago was Yahoo. Yahoo was a company that was in trouble. They tried everything to turn it around. They couldn't turn it around. and eventually they decided to liquidate it. But Yahoo years earlier had invested it in a company called Alibaba, which is a Chinese version of Amazon. And if you looked at how much Alibaba stock was in Yahoo, there was a lot more stock in Alibaba than the value of Yahoo. So if Yahoo was selling at, pull a number out of there, 10 billion, the had 15 billion worth of Alibaba stock. Those numbers aren't exact, but you get the idea. So you would, it's like buying a wallet for $10 and it's got $15 in cash inside. The cash is worth more than what you're paying for the wallet. And that was the case with Yahoo. They tried different things to try to spin off the Alibaba shares tax-free. And eventually, when they couldn't spin it off tax-free, I believe they just sold it and cashed out the shareholders. But, that's another risk. If you get everything tax-free spun off to you, that's fine. If they have to sell that and then give you the cash, they're going to pay tax on it. The same thing happened a couple of years ago with a company called Naspers. Naspers was a company in South Africa, and about 20 years ago, they had invested $36 million in a company called Tencent, which is kind of like the Facebook of China. And that 36 million, they never sold a share in 20 years. Then that turned into 200 billion. So this company that had 200 billion in 10-cent shares was selling, I believe, for 150 billion. So you're getting $200 billion worth of this Chinese company, and you're buying this stock for 150 billion. And so it's like that wallet that you paid $10 for that has $15 inside. The only problem was they had no intention of selling this stock. So they did have this money in there, but how would you get your hands on it? It should have been trading for more than 200 billion because in addition to the 10-cent shares, it had shares of other companies, but for some reason the market valued it at less than what was in there. So that's a $200 billion hidden in plain sight. So we're not talking about small obscure companies. Sometimes the companies can be quite large and the assets are very obvious. But you would need to do your homework and read the SEC filings, listen to the conference calls. This isn't something that you would find just by pulling up Yahoo Finance and looking at the price chart. And with that in mind, we're going to screen share here for a second, and we'll look at something interesting with a stock called Bausch Health Company. So here's a company called Bausch Health Companies. And a few years ago, you may have read about a company called Valeant that was in the news. And this is the successor to Valeant. So Valeant was a drug company that would buy up other drug companies, and they would raise the price of their drugs sometimes 500-600% right after they bought the company. So it had a very interesting reputation. And at some point, Bill Ackman had invested heavily in the company, and he really believed in this business model where you would buy up these small companies and just raise the price of the drugs, 400-500%, and you can make a lot of money at it. So Martin Shkreli had done something similar, and he was seen as a villain. But for some reason, this company didn't get as much hate as other people did for doing that. And if you'll see, once he got involved, this price sort of shot up, and it got to a high of $257 in 2015, so about 8 years ago. Then this bottom fell out of this, and it collapsed, and at its low, it was $4 a share. So it went from $257 to $4 a share. So you would have lost more than 95% of your money if you had invested at the high. And the reason it traded at $257 is because somebody who sold at $257 sold it to somebody who bought at $257, who thought to himself or herself, this stock is way too cheap here, it's going to go higher. And that never happened. But some things came out about the company's accounting irregularities, doing things with a subsidiary to boost the price, and other types of legal schemes that were alleged. And so the stock crashed. And as I said, it got down to as low as $4 a share. And now it's $8.31 a share. So they have different drugs that they sell, some for skincare, some for stomach ailments. And then they did buy the company Bausch Lomb, which you may have heard of, that has the eye care division. And what they did is they brought in somebody named Joe Papa, who is a very talented and well-respected person in the pharmaceutical industry. And he sort of, for a while there, turned the company around and stabilized it. It was on the verge of bankruptcy. It had a lot of debt. And he paid down the debt. He rationalized some of the businesses. He cleaned up the balance sheet. And this company still has a ton of debt, and it's in trouble. But it's trading now at about a $3 billion market cap. So if we go back to 6 months, 1 year, you'll see that at one point, it was $22 a share, and then it got cut in half when there was some patent issue. But anyway, back to where we were, it's $8.34 a share. So the value of the entire company, if you were to add all the shares, is $3 billion. So one of the things they did to try to unleash the value that's inside is split up the different segments of the company. So, I mentioned they have one part of the company that does gastrointestinal drugs, and another part of the company that does skincare type stuff. And the eye care business, which is sort of like the crown jewels, Bausch Lomb, they wanted to spin that off. So they put that as a separate subsidiary, and then they spun off 10% of that. And that became Bausch Lomb Corp right here. You'll see it's so 10% of the company they spun off, and Bausch Health still owns 90%. And the name changed obviously from Valeant to Bausch Health Company. But Bausch Lomb was spun off, and 10% of it was spun off. Bausch Health still owns 90% of it. So the 10% that was spun off, that's worth $6.073 billion for 10% of that. But the other 90% is owned by this company, and 90% of it is in this company, and it's trading for $3 billion. So 90% of $6 billion, there's $5.4 billion worth of publicly tradable Bausch Lomb Corp shares, $5 billion worth in this company, where you could buy the whole company for $3 billion. So what's the problem with that? Well, the problem is it's stuck in there. And the previous CEO said that he wanted to get the debt down to a respectable level, and then he would take 10% of that Bausch Lomb stock and sell it and use it to help pay back the debt. And then he would give shareholders the other 80% in a tax-free spinoff. So 80% of the $5.4 billion of Bausch Lomb Co. stock that's in here, that would be $4.86 billion. So again, this entire company is trading for $3 billion. And if you can buy this company and just wait a little bit, then theoretically, after they spun it off, you would get $4.86 billion in Bausch Lomb Co. stock. And then you'd still have this stock, and it would be worth whatever it's worth, but you would be making a huge return on this, right? You'd be making not quite double your money, but you'd be getting $4.86 billion of Bausch Lomb Co. stock, which is a great company. They make contact lenses, the best producer in the world at that. And then you still get to keep this company, and it's worth whatever it's worth. They have the other drugs that they make for gastrointestinal stuff or skin care stuff. And, they could sell that, or you can keep it, and it's worth something. You don't know what it's worth, but you do know that you're getting that Bausch Lomb Co. stock. So what is the problem with this company? Well, again, you'd have to listen to the conference calls and read the 10Ks. But if you look at the statistics, one of the problems is that they have $23 billion worth of debt. So, 2 billion, almost 3 billion market cap, but $23 billion worth of debt. And that debt is huge, right? It's 10 times their market cap. And when this was a $257 stock, maybe that 23 billion wouldn't look too bad. But now that it's a $8 stock, this is 10 times the value of the company. So that's going to be a problem, right? Because the CEO had said, once we pay the debt down, we'll use 10% of that Bausch Lomb Co. stock to pay down the debt, and then we'll give you the rest. We'll give you the 4.86 billion. But even if they had used all of the Bausch Lomb Co. stock, remember that's 5.4 billion, they wouldn't be able to pay down this debt. And then you'd be stuck with a $3 billion company that still has $18 billion in debt. That's if they sold the stock and use it to pay down the debt. But they don't want to sell the stock. They want to give it to you. So is there a problem with giving it to you? Sure. They have $23 billion of debt. And when companies issue debt, bonds, they usually have things called covenants in them. And the covenants prevent you from doing things that would harm the bondholders. So for instance, if I owned a company that had a bunch of hotels and I issued debt on it, bonds, those bonds, that's collateral for the bonds. And if I don't pay them back, they can put me in bankruptcy and take the hotels. Well, what if I issued the bonds and then I sold all the hotels? Then the bondholders wouldn't like that because there would be nothing they collect. So normally when they issue these bonds, there are certain covenants in there to protect what they're lending money on. And some of them prevent you from selling assets, and some of them require you to maintain a certain debt to equity ratio. And here, as you can see, the debt to equity ratio is very high. So commonly when you see that, either you're violating the bond covenants, or the bond covenants would require you to get bondholder approval before you can sell a significant asset or spin it off. So what Bausch did recently is they exchanged some of their debt for a different type of debt, and they gave the bondholders a premium about 50 basis points. So they took the bondholders and said, whoever wants to participate in this, we're going to take your debt, give you the same debt, but with 50 basis points higher as a fee. And in exchange for that, you're going to waive some of these covenants in the new debt. And with some of the covenants waived in the new debt, they were able to take that $5.4 billion of BLCO stock, and they put 38% of it in a subsidiary that's unrestricted. What that means is the part that is in the main BHC company, they couldn't sell because it would violate these bond covenants, but that 38% of it that they put in this unrestricted subsidiary, they could do whatever they want with it. They could sell it, they can give it to their shareholders tax-free, or do anything else they want. Is there any problem with that? Yes, because one of the problems is that when the stock went from $257 down to $4, there were a lot of people who owned the stock who were very angry about this, and they were suing because of the fraud and other mismanagement that was alleged to have occurred when it was Valeant under the previous CEO. They were suing and they wanted to get some money from the company for this. So even though the bondholders had exchanged their old bonds for new bonds and they waived some of these covenants, the people who were suing the company, who were the previous shareholders, said, well, if you spin this off, you're not going to have enough money here for you guys to pay us what you owe us if we win these lawsuits. So they sued in court to try to stop the spinoff. And if you look at this company, you will see press releases about this lawsuit. And if you read those not carefully, you might think that Bausch Lomb won that lawsuit because it said that the case was dismissed. And so if you bought this, you might think, well, okay, that lawsuit's gone, the covenants are waived. So now I can buy this company and they'll give me $4.86 billion worth of Bausch and Lomb shares, and for this company that I paid $3 billion for, and I'll go live happily ever after. But if you read the actual judgment, the lawsuit wasn't dismissed exactly in Bausch Health Company's favor. So in the law, there's this concept called ripeness. So the courts review actual cases and controversies, not hypothetical cases and controversies. And the reason that this case was dismissed is that the judge said that this case isn't ripe yet, because although Bausch Health Corp took some steps to spin this off by getting the bondholders to waive the covenants and putting this in a separate subsidiary, they still haven't filed anything with the SEC, which would be required for them to do to spin this off tax-free to shareholders. So until they've done that, this is all theoretical. You can't sue because they might do something one day. You sue to prevent them from doing something that they're doing now, or to get an injunction to do something that they're about to do. But this hadn't reached the point where it was far enough along that this could be heard in a court. So that's why the dismissal was there. But the judge specifically said that, when this is ripe, Bausch will let you guys know, and within 14 days, and you can refile your lawsuit. So that's where we stand. You've got this problem here. It looks optically cheap because it's a $3 billion company that has 5.4 billion of publicly traded stock in another company. But, you've got this problem where the only amount that you can spin off now is 38% of that, because that's what you've got approval for from the bondholders waiving their covenants. But even if you did try to spin that off, you're going to be hit with a lawsuit from the shareholders who were hurt when the stock went from $2.57 to $4, and they want to sue. So if you hold on to this, one, you might never get that Bausch and Lomb Co. stock. Two, what if these lawsuits move forward and they say you have to pay these shareholders a lot of money? That stock might be used to satisfy those judgments. So again, this is something which optically looked cheap. It looked like value hiding in plain sight, but we always have to do your research and dig deeper. So again, this was not something recommendation to buy or sell, but just letting you know that sometimes when you look at something, you have to dig deeper than the numbers to see why something is so cheap, because sometimes things are cheap from a reason. And if you look at things like the price earnings ratio 11, that's pretty good. The forward PE 2, that's great. The enterprise value to EBITDA, that's really cheap at 7.52. And the reason that it's cheap is that there's a lot of hair on it, and it's something that's very risky. And it's just something that just a reminder that sometimes things are cheap for a reason, and you can get good deals out there, but you have to do your homework. Nobody's going to do your homework for you. So let me stop the screen share here, and then we'll go back to me. Sometimes you have to, as I said, just dig deeper and look at why something's cheap, and sometimes it's cheap for a reason. This might be, and sometimes you keep digging and then you don't find a reason, and you're comfortable with it. So a few years ago, I owned a company, shares of a company called PBF, which has refineries, and if you looked at how many refineries they have, and they owned 50% of another publicly traded company called PBF Logistics. And then, if you added how much of that publicly traded stock they own, how much each refinery is worth, and they also had pipelines, and you add all those pieces together, and you would come up with a number that was 40% less than, 40% more than the stock was trading for. So I felt comfortable buying that, and I did really well on that, and I sold it. Haven't looked at it in a few years, but it's just one of those things. If you're familiar with something in an industry, you just keep looking and then turning over rocks. Eventually, you may find something hidden in plain sight. And when I was in private practice, I represented a lot of cable, telecom, energy companies. So, one of our clients was a company that had natural gas pipelines. So, I was familiar with some of those companies, and, refineries were not too far outside my comfort zone. So I was able to look at that. But, as I said, other companies, like healthcare companies, things with drugs, normally I don't get involved in those because I don't have any experience with that. Same thing with banks, biotech. I stick to my knitting, things that I'm comfortable with, things that I know about. I can feel comfortable digging through the 10K, listening to the annual reports, the conference calls, reading the annual reports, and I can feel comfortable enough that I would invest in them, but other things I wouldn't. And as I said, there's a lot of work involved if you want to pick individual stocks. And if you don't want to do that work, you're much better off just buying index funds. Just buy the index, and then you're betting on America. Or if you buy an international fund, you're betting on whatever country you're investing in. They'll do all the work for you. Most professional money managers can't beat the index, the S&P 500 index. So just buy the index and just keep it in your account. Don't even look at it. And when you're ready to retire, you'll open up your account and you'll see that you did really well. So anyway, like and subscribe to this. I'm going to be putting out more content, and by liking and subscribing, you'll be able to see it, get notice of it when it comes out. And if you have any questions, just put it below, because I want to put out content that you want to watch. So if you leave a comment, I'll know what kind of things you like to see, and hopefully put out more of that. So in the meantime, have a great day. I hope you make a lot of money in the market. Leave no dollar left behind.